sense. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
Live from Sydney, this is Insight with me, Heidi Stroud-Watts. President Trump there giving himself and others a way out of tariffs if something phenomenal is offered. But what's phenomenal so far is the continued pain on these markets. Before we get to that broader sell-off, though, let's zoom in on South Korea. Stocks there are swinging on the Constitutional Court ruling to oust impeached President Yoon, triggering an election. Let's get to my Asia Trade co-anchor, Sherian. He is on the ground in Seoul and joins us live. And we've seen the crowds building really there for weeks. The environment, the atmosphere is really incredible.
Yeah, these are all protesters that wanted to see President Yoon impeached. Right now outside the Constitutional Court. And protesters have now been marching towards Gwanghwamun behind me. Right now, the mood, as you said it, is very celebratory. There's been music blasting from both sides, speakers all around. They're very happy to have President Yoon removed. The Constitutional Court unanimously deciding to uphold that impeachment decision by the National Assembly with a vote of 8-0. Now, they said that the benefits from removing Yoon far outweighed the fallout, including the fact that Yoon shocked the public, that caused confusion in the economy, and he violated the Constitution and the rule of the law. We already heard from the ruling party that they will adhere and follow the Constitutional Court's decision. We heard from the People Party leader Kwon Young-se coming out and apologizing to the public. We are now expecting to hear from the opposition leader Lee Jae-myung any point now. We have heard from the acting president Han Dok-soo that he will manage the administration very stably. They are now convening a meeting in order to discuss Korea's financial markets as well, just to bring stability as we head towards that snap election triggered within 60 days.
Sherry, the opposition leader is doing quite well in the polls right now in terms of the sort of the top choice for replacement. What does that road to the election and leadership look like? And what are the challenges that the new leader will be having to face?
If he was elected today, he would definitely become the president of South Korea. As you said it, he's leading the polls. Lee Jae-myung has been acquitted as well himself just a few weeks ago when it comes to charges against him on election law violations. So he's had a higher chance since then to succeed. His party also just had a landslide victory when it comes to parliamentary elections last year. So his party actually controls the National Assembly. What that means is that we could see a larger supplementary budget pass through the National Assembly. That could give the South Korean economy a much-needed boost. Of course, we have 25% reciprocal tariffs coming from the U.S., not to mention, of course, 25% on auto tariffs that have taken effect this week. Now, we are seeing a huge wave of protesters right now approaching towards us, so we may have to move the position. What's happening right now is that they're marching from the Constitutional Court very slowly towards the Gwanghwamun area behind me. So things are going to get louder, but people are now just yelling about ousting the president and them having been victorious.
Very own Sherian, they're in Seoul, and the sort of level of organised protest in Korea is really something to behold. But this was always a decision that was going to potentially drive that wedge further between progressive and conservative voters in the country. But there is certainty now to some extent as we head towards that election that has now been triggered that takes place within 60 days. You can get more on the latest on this on your Bloomberg. That's TLR Vigo to get that commentary and analysis from our team of expert editors. And this is what we're seeing when it comes to that market reaction to some relief is expected for South Korea, because this has been a domestic political drama that has been dragging out for months now. We've seen the impact when it comes to domestic growth. We've seen the impact when it comes to the hindering of high-level diplomatic talks, not to mention now these challenges coming externally from these Trump tariffs to a very externally vulnerable economy. Broadly speaking, we are just seeing that sell-off continue unabated. Of course, it was such a tough session that we saw overnight. We're now seeing Asian stocks falling to a 2-month low, extending that global sell-off in stocks. We're seeing pressure not just on stocks, though, but also the likes of the broader commodities complex there as well. Probably just as well that we do have a number of key markets, including China, that are away on holiday today, and that's sort of taking away perhaps for some even steeper selling. But you can see the level of risk aversion that we're seeing today. And as I mentioned, a lot of this was really coming off the back of what was a troubling session on Wall Street. US assets have been some of the hardest hit in this tariff storm. Avril Hong is here, and it certainly doesn't kind of contribute to any kind of recovery prospect for this idea that American exceptionalism in these markets might be over.
Yeah, I think that tariff storm that you described really denting the case for U.S. exceptionalism. We see how U.S. assets were among the hardest hit, as you say, and today we're seeing that extension of those losses in terms of stocks, the yields on the treasuries, as well as the dollar. I mean, you look at the deep losses on the S&P 500 overnight in terms of U.S. market value being wiped out, about $2.5 trillion worth. And the companies that were hit the hardest were those with this dependence on supply chains with overseas manufacturing. And then you look at how the dollar has pretty much erased all its gains since Trump's election win, hovering at the lowest level since October. And of course, there is this debate, right, whether the tariff storm is going to prompt more Fed cuts, the likes of UBS see 4 potentially this year, versus none at all, which is the case that Morgan Stanley is predicting, and a bit of that clash underway. But we're seeing, I think for now, Treasuries agreeing more with UBS, the yield on the 10-year below the 4% handle. Now, flip the board. I just wanted to give you a further sense of how this selling has spread to commodities as well. A Bloomberg gauge of them saw their steepest one-day loss since 2022. It's those concerns about a global slowdown impacting demand for metals, crude, agricultural products. Flip the board again. At the heart of the matter is how the tariff announcements were supposed to provide more business uncertainty, and many economists say it's just done the opposite. A Bloomberg survey of 50+ economists after the tariff announcement actually shows you overwhelmingly they think there are higher recession odds, inflation expectations, trade uncertainty amid all this, Heidi.
Avril, with a look at that extraordinary trading session that we saw overnight. And we did hear from the US Commerce Secretary Lutnick saying that the US trade partners must address non-tariff trade barriers, including regulations and other policies limiting American imports as part of negotiations for relief. Lutnick says the Trump tariffs will quickly trigger a rush of manufacturing returning onshore.
What CEOs are thinking about is finally, let's think about building in America. You've got almost $5 trillion of commitments coming to America to build their factories. That number's only going to grow as people realize it's time to bring manufacturing home to America, where the greatest economy and the greatest market is in the world. You're going to see great growth from America.
Let's get more on these markets with Ed Yardeni, who's the president of Yardeni Research. Ed, great to have you with us. And I actually wanted to get your thoughts on the premise of what we heard from Lutnick there. And of course, what we've heard as the broader argument for tariffs is that it will return American manufacturing in some of these, long phased out sectors like textiles manufacturing, for example, back to US shores. Do you think that this is going to happen? How does this play out when it comes to creating benefit for America?
I think there's a tendency to exaggerate by this administration about all the wonderful things that are going to happen. I don't know what's so wonderful about bringing textile manufacturing or sneaker manufacturing back to the United States. I don't even know whether we have the workers to help us produce those kind of products. And they're definitely produced much more cheaply overseas. If the goal is to focus on national security, then that should be it. It should be steel and aluminum. I don't really understand the need for tariffs on autos from a national security perspective. And certainly it makes no sense to have tariffs on textiles from a national security perspective at all.
How does this play out when it comes to the knock-on effects? Because if you take a look at the reaction that has been sustained from the investment community, clearly this doesn't feel like, you know, something that that markets can just shrug off.
No, you're absolutely right. And I hope that the message that the stock market is sending to the administration is being heard. The market's giving a big thumbs down to this tariff policy. I hope also that there'll be a big political backlash. I'm hearing that senators and representatives in Congress are getting flooded with calls from people who are complaining that their stock portfolios are going down. A lot of baby boomers are retiring, and they, they're boarding cruise ships and watching their stock portfolios on their cell phone, and they were very happy when stocks were going up to record highs, and now they're getting quite concerned. So there could definitely be a significant slowdown in the economy, but there could also be a significant pushback on a political basis. I mean, the Republicans are going to lose the midterm elections year if they don't do something to defang this reign of tariffs.
Reign of tariffs. This is shaping up to be, I think, the worst 10-week start to a presidency for the stock market since George W. Bush in 2001. And that was, of course, when we're talking about the dot-com era as well. But do you think that this really pushes back the narrative of American exceptionalism in risk assets, or is this a temporary blip? Do you want to be kind of looking at dip opportunities in this sort of environment?
Well, I think some great opportunities, great buying opportunities are being created here in the market. I mean, the U.S. still stands out in the realm of technology and communication services. The Magnificent Seven are quite unique to the United States. I know that the people have been talking about the Magnificent Four in China, but the United States does extremely well there in technology. We do very well in financials. I think our industrial sector is improving, but there are issues that the administration rightly is focusing on with regards to national security. That includes pharmaceuticals, it includes semiconductors, it includes the ability to produce our own steel and aluminum for the purpose of building national defense weaponry. So there are legitimate concerns, but this is way too sweeping an approach. And as the president said, he's now willing to listen to phenomenal offers from people on the other side of the table. And I think he's going to back off. I think he's going to back off in a way where he could declare his victory. He'll get some concessions from our trading partners, and let's say that's good enough. And hopefully this whole thing will kind of be behind us within the next 3 to 6 months. Maybe that's too optimistic, but I'm hopeful.
3 to 6 months still seems like a long time for confidence to drop and then sort of stay entrenched at lower levels, right? How resilient do you think, household sentiment, corporate sentiment is going to be, given that even going into this prior to the tariffs being announced, we've already seen a lot of preemptive, reorganization of supply chains?
The administration keeps talking about the trillions of dollars that are being committed to build factories here. We've had a factory building boom for the past 2 years because of Biden's stimulus to onshore. And I think what the president is trying to accomplish to bring more onshore without the government providing any incentives other than maybe threats that if you don't come here, you're going to have a tariff. But, these are kind of not exactly legal commitments. It's companies publicly stating that they have an intention to spend a lot of money. Meanwhile, if confidence continues to drop on the part of CEOs, they're going to cut back on capital spending. Same thing with consumers. If their confidence continues to drop, they'll retrench. The really odd thing is we're going to have like a very weak first quarter. Then we're going to like a really strong second quarter because people are already scrambling to buy cars before their prices go up. We had a big surge in car sales in March, so we can have a strong April, May, and then everything could fizzle in the second half of the year.
Your own risk of stagflation and recession are about 35% and 45% respectively. There are some others that feel a little bit worse about it. JP Morgan sees a 60% odds of recession. How do you view kind of that trajectory and also the implications for the Fed, right? Because it sounds like, and I don't blame them, the Fed also is being very careful in terms of how they maneuver the next few months.
Well, there's a lot of nuance here. I hear that a lot of the economists, some of my competitors, are now saying there's a better than 50% chance of a recession. They say if the tariff situation isn't ameliorated in the next few months, and I agree with that. If things are as bad on the tariff front in 3 to 6 months as they are now, then sure we'll have a recession. But I think there will be a political response. The Republicans don't want to lose their majority in the midterm elections next year, and they have to think about that. If they cause a recession in the second half of the year, that's going to linger in terms of the kind of the bad feelings that people have towards Republicans. So I expect that there will be a pushback. I expect that 3 to 6 months from now, there'll be other issues to deal with. So I'm expecting a slowdown in the second half of the year, but not an outright recession. I would say 45% is my number for the risk of stagflation and or including the possibility of a mild recession.
Do you have targets in mind when it comes to the S&P 500 and the NASDAQ?
Well, they keep, I keep changing them. I had the past 3 years. It's kind of nostalgia. I had a really great run in forecasting the economy and the stock market. I started out the year optimistic, like most, but I was near the top of the range with the S&P 500 at 1,000. I was arguing earnings would be really strong, and the valuations in that kind of environment could stay up. But over the past, well, really since early March, I've been kind of fading away. And I went from 7,000 to 6,400 a couple of weeks ago, and then a week ago I went to 6,000 on the S&P 500. So I'm changing my mind as often as the president is changing his mind.
Just trying to keep up, right? Given there's so much uncertainty when it comes to the US economy, US assets, are you tempted to diversify elsewhere? I mean, there was one argument that Chinese assets might be the ultimate diversifier in this environment.
Well, I'm more inclined to think that gold is the ultimate diversifier. It's been a fairly steady appreciating asset. Other assets have kind of fallen by the wayside, including Bitcoin. I'm skeptical about the China story. I know that the stocks have done very well of late, and there's been a move to Chinese technology, but those stocks have come down along with the Magnificent Seven recently, and I question the ability of the Chinese government to really stimulate their economy when they still have an awful property situation where real estate prices are still depressed. There's still a huge negative wealth effect in real estate. And then there's also the geriatric issue. It's a very rapidly aging population. So put it all together, if you try to stimulate consumers, that's fine, but you have to factor in demographics. Old people don't go anywhere. They don't travel as much. They don't have kids. They don't have they don't have family to spend money on, and so it's conceivable that consumers, if they're given some breaks here, will save rather than spend, or at least they won't take advantage of the incentives to buy cars and appliances that the government's providing. So I'm skeptical of that story.
The geriatric dividend, or the lack thereof. I wanted to go back. I think your latest target on the S&P 500 was 6,000. Yeah. What is it now? Just for now, as we speak. You're welcome to change your mind in 5 minutes if there's another headline. And also for gold. Where do you think gold is going for here?
Well, I I've never been a gold expert. I'm still not a gold expert. I'm an old-fashioned strategist. I like to have dividends and earnings and coupons and income streams to discount. But just kind of looking at the charts as an amateur technician, this I think has the potential to actually get to 4,000 by the end of the year and 5,000 by the end of next year. But that's within the context of ongoing global chaos, which seems like a reasonable bet given the have been unfolding of late.
Would you buy the Mag 7 at this point?
Would I what?
Would you buy the Magnificent Seven or any of the Magnificent Seven at this point?
I think they're still magnificent. It's ironic that, a few months ago, everybody was talking about American exceptionalism. Sometimes when anything becomes a consensus view, and I think he even made the front cover of The Economist in October, that America's economy was like clearly better than anybody else's. And wouldn't you know it, ever since then, everybody's lost their interest in the idea, or they kind of question that idea. But look, we still have amazing capital markets here. We still have lots of money available to fund all sorts of entrepreneurs. We have a very solid financial system. Our industrial base is really quite good. I mean, I say this without kind of political bias. This president inherited a really strong economy, 1% unemployment rate, inflation just a little bit above 2%. It was really in good shape, and I kind of question where we're going to find bodies, where we're going to find workers if we bring all these amazing jobs back. And like I said, I don't think Americans are rushing to be producing textiles and sneakers. They just as soon have those made overseas where labor is still relatively cheap and import them.
Ed, really great to chat with you today, as always. Ed Yardeni, who's the president of Yardeni Research. Still ahead this hour on Insight, Jefferies Wealth Management joining us with their investment strategies after Trump shocks markets with more hawkish tariffs than priced in. Plus, Asia is bearing the brunt of these new US tariffs. We'll be speaking with the Philippine Trade and Industry Secretary Cristina Roque on how they plan to respond. This is Bloomberg. Take a look at how we're tracking here in Asia as this Trump tariff-induced sell-off continues. We are seeing the broader MSCI Asia Pacific off by 1.5%. Some of the steepest losses again for another session being seen in the likes of Japan, as we see the topic sliding as much as 3.7%, now down 10% from the previous peak. We're seeing downside when it comes to Singapore as well. In Australia, we're seeing losses of just over 2%. This as we're seeing healthcare, consumer stocks as the most exposed to these tariffs, according to Morgan Stanley. We're also watching some of these emerging markets, including Vietnam, where stocks are falling for a second day as well. Korea on watch. A brief respite for the won as well as Korean stocks with the upholding of the decision to impeach President Yoon, but that has now started to fade. More market analysis is next. This is Bloomberg. Monumental day for Korea. As you can see, the crowds that have been building over the days and weeks out on the streets of Seoul outside major metropolitan areas, but particularly gathered around the Constitutional Court, where that court has today elected to remove President Yoon Suk-yeol from office over his martial law declaration. It now paves the way for a presidential election to take place within the next 60 days. This really marks a potential conclusion and a turnaround for Korea and the divisiveness that we've seen within the political political system, one of the most turbulent political chapters in the country's recent history. The next leader is now tasked with handling some immense external challenges as well, including, of course, top of mind being Donald Trump's global tariff campaign, a more emboldened North Korea, something to worry about as well. This is an election that's set to determine who's going to inherit also an economy that faces multiple both domestic and external risks, as well as, of course, just that broader tariff impact of the plans to restructure global manufacturing to bring that more back to the US, posing a risk to a lot of South Korean companies, of course, that are very deeply embedded one way or another within these global supply chains. You're seeing, after a brief sort of bit of upside when it comes to the won and Korean stocks, we've now resumed that weakness. Well, Commerce Secretary Lutnick says his teams are talking with US trading partners about President Trump's latest tariffs, but they must realise that what he calls the free ride is over. Lutnick told us that the world will quickly adapt to the new trade order.
Donald Trump is focused on the economic pain that the United States of America has suffered over decades. Since NAFTA, 90,000 factories, not jobs, factories, 5 million high-paying jobs gone overseas. He's focused on the U.S. worker and the U.S. economy. And what's going to happen is people are going to realize it is the great American economy that is the winner here. And anyone who doubts it, and anybody who shorts Donald Trump, or anybody who doubts the strength and the power of the American economy is making a foolish bet. Sure, importers are going to have a tough time figuring out what to do because they went and found the cheapest production in the world. It's time to bring that production home, to have the smart, amazing people who run American companies figure it out, bring robotics back to America. And I would say that United States domestic growth is going to have the greatest resurgence ever under Donald Trump, and that's what he has set in motion yesterday.
You'll accept it takes time to engineer a supply-side response, though, sir. And in the meantime, you can see bad things happen. Do you accept that?
Well, what I can accept, of course, it takes time to build factories, but companies understand how to do it. They will do it. The United States of America is the greatest economy in the world. People have to do business with it. The rest of the world will bring down their trade barriers, and you'll see a great resurgence in our ability to sell agriculture overseas. You'll see factories being built here, and that factory production will be faster. So sure, there will be a rebalancing of those who make things in cheap labor markets, figuring out how to make them here. But ultimately speaking, and I think in much less time than you think, the world will reorder itself, will figure it out, and the United States growth rate will turbocharge compared to the rest of the world. We've been too close to them because we've been, our presidents have been presidents of the world, and Donald Trump ran on the policy that he was going to be the president of the United States, of the workers of the United States, and he was going to place American workers first. And that's what he did yesterday, and that's what everybody's feeling. Those workers have been disrespected, and now they're going to be respected.
Mr. Secretary, just a final question, if we may. Any calls scheduled for today with the Europeans? Do those negotiations start this morning immediately? Can you give us a sense of things?
Absolutely. Our teams are talking to all the great trading partners today, and we are available for our great trading partners every day. It is time for them to do deep soul searching of how they treat us poorly and how to make it right. It is time for them to do that. That is going to be difficult for them because they've taken advantage of us for so long. They should just be disappointed that the free ride is over. It's time for them to be realistic and to change the way they look at the United States of America.
US Commerce Secretary Lutnick there speaking with Bloomberg surveillance anchor Jonathan Ferro. Joining us now is Laurie Goodman, who's a global head of investment and wealth solutions at Jefferies Wealth Management. Laurie, great to have you with us. So we've had a couple of days now to kind of pass this decision, sort of model some of the outcomes. The markets clearly are still not feeling comfortable with what we're facing. How are you navigating this?
Yeah, I wish I could say it was as optimistic as your last speaker. Markets are certainly having a very different reaction. Now, one of the things that's interesting is that while most of the commentary and certainly the market reaction reflects that the tariff announcements were more hawkish than anticipated, the reality is that Trump did exactly what he told the world he was going to do. In fact, we have an analyst, Anika Shah, who covers DC for Jefferies. He put out a note in July of 2024 called Day One, 10 Policies to Expect if Trump Wins. And he wrote, he expects that they're going to align tariffs with those of trading partners, planned imposition of 10% across the board with 60% on China. Okay, it's 54%. But he's doing exactly what he told us he was going to do. But we have concerns about what this is going to mean for geopolitics and for economics.
What are some of those concerns? And is there a way, when it comes to building sort of a safer portfolio, that you can try and navigate them from this point?
Yeah, absolutely. So the first implication of what we're anticipating is slower global GDP growth, especially slower U.S. GDP growth. So, in Economics 101, I learned about specialization of labor. Basically, if Jack is better at hunting rabbits and Jean is better at foraging berries, if they each spent half their time doing both of those things, they'd end up with less overall than if Jack just did what he was better at and Jean just did what she's better at. The pie gets bigger, right? So globalization was built around this, and we've been through a period pre-COVID where we had very low inflation. We've had a lot of global peace. This all gets derailed. And the market cap of the U.S. industrial sector going into this was $9 trillion. The U.S. did focus on the highest end part of manufacturing, and that was very deliberate. The other thing that we're anticipating is higher inflation. We could have had reciprocal tariffs in the past, but the prior administrations made a point to say, listen, we want to benefit U.S. consumers by allowing cheaper goods. We were not imposing reciprocal tariffs because the U.S. consumers benefited from the fact that we didn't have the reciprocal tariffs on. By contrast, the current administration sees tariffs not only as a means to correct the deficit, but also a way to revive U.S. manufacturing. We saw glimmers of this need and this desire to revive U.S. manufacturing under Biden, for example, with the CHIPS Act. But the prior administration was using subsidies. Well, this administration is using tariffs. The other thing that's important to note is that COVID really reversed a trend that we hadn't seen for many years prior, really where companies were afraid to take up prices. Now we're at a point where COVID unlocked that, and companies have deployed strategies, sometimes tech-enabled strategies for price discovery. And when you have a situation where there's an excuse to raise prices, it's a little bit like you've let the inflation genie out of the bottle. If we go into, what are some... Yeah, please go ahead.
No, I was going to ask you about what that makes you think about sort of, American exceptionalism on the stock market, and is this a time that you want to be sort of seizing opportunities to diversify more internationally?
Yeah, absolutely. Absolutely. We think now is a really good time to correct any historical underweights that investors have had to international equities. We also think it's a really good time to increase exposure to quality and defensive stocks. And it's a time to focus on uncorrelated and less correlated assets. I know your prior guest was speaking about gold. We're also seeing a lot of advantages in certain areas of alternative investments, particularly some niche areas in private credit, like asset-based lending, strategies that are taking advantage of non-economic sellers of loans, and also infrastructure assets.
Would you be looking at any of the markets sort of in Asia as being particularly compelling? Do you think there are opportunities in China, for example, as really kind of, a very different sort of diversifier away from the United States market?
Yeah, we're going to be looking at increasing exposure globally. So China, Asia, and certainly certainly Europe as well.
alternatives and private markets have also become quite popular, particularly in light of what we've seen in public markets. Is that something that you think has a reasonable part to play when it comes to a portfolio like this?
Yes, absolutely. I think you need to pick your spots, right? So areas like private equity, where we've seen a delay in deal activity, I think all of this uncertainty, unfortunately, is likely to continue the delay in deal activity. And so there's going to be a slowdown there. Those strategies are also particularly susceptible to a higher rate environment. But areas of private credit where a lot of the debt is floating rate could benefit if we're going to be in an inflationary environment. And you can find asset-based lending strategies where there's hard assets against the loans that could also benefit.
What are the specific opportunities that you see in a higher inflation environment, potentially even a stagflationary environment, not to mention recession risk for the US is also being driven up even over the past couple of days?
Yeah. Well, it goes back to gold, and it goes back to those diversifying strategies. You know, macro strategies and trend following strategies also tend to do very well on the more liquid end of the spectrum. So I would throw that in there with our recommendations around private credit and real assets.
How do you feel about the European market at the moment?
I think it's interesting. I certainly think that European defense companies are very interesting. That's going to be a renewed area of focus. You know, we've seen what's been going on in Germany and the expenditures there. Europe does have its problems, though, right? You know, getting a bunch of disparate countries to agree and work together has not always worked as well. Obviously, those countries have a lot of different regulations. That's why the U.S. has historically had a big advantage. Maybe this will be a bit of a wake-up call for Europe to think about spending more on defense and spending more fiscally.
You know, I wanted to finish by going back to where you started, which is the fact that, you know, you and your colleagues clearly believe that this was going to happen because you take what the president says at face value when he says he's going to do something. Does that mean you really operate from here on with the belief that these tariffs are going to stick, or do you keep some flexibility in case, you know, some countries do negotiate their way out of them, or for whatever reason the policy is changed by the administration?
Yeah, I'm really glad you brought up that point, because there's a lot of different scenarios about how this could play out, and I don't think anybody really knows. I think we're really in unprecedented territory. So, you know, the hope, and certainly the hope of the administration, and it's a possibility, is that countries do come to the negotiating table. That they say, okay, you know what, we want to do business, we want to be open for business, we want to trade with the U.S., we're going to reduce our tariffs on U.S. imports. The administration responds by, in turn, reducing the tariffs that were just announced and declares victory, right? That's one scenario, and that will be obviously very, very good for the markets, and we'll see a rebound in that scenario. The adverse of that is, or the opposite of that, is that we have reciprocal tariff after reciprocal tariff. There's a global trade war, and that's going to be terrible for global GDP. And then I think there's another scenario where other countries start to band together. China continues to expand its influence. China and Europe continue to work closely together. They work more closely together. And the U.S. is largely left out of the growth. It's at this point, it's really too early to know how all of this is going to play out, which is why, you know, when we talk about other strategies, it's really sort of with the tactical portion of your portfolio, because we want to be a little bit careful around market timing. There's still just a lot of uncertainty out there in the markets.
Laurie, really great to have you with us. Laurie Goodman, Global Head of Investment and Wealth Solutions at Jefferies Wealth Management. Still to come on Inside exclusively, we'll be speaking with the Philippine Trade Secretary as Southeast Asia maps out their response to Trump's tariffs. This is Bloomberg. President Trump's tariffs are prompting traders to ramp up bets on more aggressive rate cuts from Southeast Asia central banks this year. Avril's back with more, and perhaps unsurprising, but it's a challenging time to be a central banker anywhere in the world right now.
Yeah, but especially so in Southeast Asia. I mean, we've been talking about this in the past day or so, right? Just how high on Trump's chart some of these countries, ASEAN nations, were on that very list, including the likes of Vietnam and Thailand. And that's, I think, prompted this readjustment in central bank expectations from traders. I mean, you look at how the impact potentially could be on growth, on sentiment, that is spurring bets that we could see more aggressive easing from these central banks in the region. And on top of that, it's really interesting that, you know, you get the sense there are winners and losers amid all this, that ultimately, when you look at the tariff rate, some in the Southeast Asian nation group, they actually could be benefiting. You look at Singapore, right? The idea that it could be a sort of safe haven given the relatively low rates that are being levied against it. The Philippines also potentially a beneficiary, because after all, this is all relative. But we still have some of these economists that think that this would mean weaker Asia currencies overall. I mean, it's interesting today, despite that sense that Asia currencies are mostly climbing, Heidi, as the dollar slides, and this includes the likes of the Philippine peso. We see quite clear outperformance today, according and along with the likes of the Malaysian ringgit, I should say. And of course, this is partly to do with the continued slide in the US dollar, but that's despite inflation data in the Philippines slowing to a 5-year low. So ultimately backing the case for a rate cut from Banco Central next week. And this is, of course, Heidi, even amid heightened global uncertainties.
And then you've got the likes of Vietnam, right, which was really a standout alongside Cambodia in terms of the worst hit and the worst targeted by these Trump tariffs. And we've seen the government today come out and say how disappointed they are. They have asked the US to put a halt on the tariff plan and to be open to negotiations. And it's quite interesting, isn't it, Avril, that Vietnam's also one of these nations that really went on a charm offensive prior to this, you know, promising to buy big ticket items from the US, and yet we're still slapped with one of the heftiest tariff rates out of any of the countries in President Trump's chart. I do wonder, does this set up a pretty complicated picture for these central banks? Because a lot of these economies, you know, are not exactly, you know, totally free from the constraints of fighting inflation.
Yeah, and I think you look at that battle between expectations of growth and the inflation outlook. That's not just something reflected among some of these Southeast Asian banks, right? I mean, you look at how complicated this makes things for Fed expectations as well. We were talking about earlier in the program how this influenced the expectations from UBS and Morgan Stanley. So really complicated here, Heidi.
Yeah, Avril, stick around with us because I do want to bring in our next guest, a Philippine Trade and Industry Secretary, Cristina Roque, for an exclusive conversation of how all of this tariff uncertainty is affecting the Philippine economy and how they plan to proceed. Really great to have you with us. And I wanted to get your reaction because we heard from President Trump today saying that, look, he's open to negotiations, but it would have to be a phenomenal offer that's put on the table. Is the Philippines willing to negotiate? What does the Philippines have to offer here when it comes to negotiating with the Trump administration?
Yes, hello. Yes, first and foremost, good afternoon. Thank you for inviting me. Of course, now that the tariffs have already been out, the reciprocal tariff for the Philippines is 17%, which is actually, in the onset, if you look at it, it's quite high. But compared to our ASEAN neighbors and in Southeast Asia, ours is actually one of the lowest, next to Singapore. So this will really play a crucial role for us as we strengthen our exports to the United States. So we will definitely take advantage of this, the lower tariffs, even if the prices will increase because of the new 17%. But compared to our ASEAN neighbors, we have an edge in the lower tariff rate.
What do you think the Philippines can offer that would be compelling enough or, phenomenal enough for President Trump to consider sweetening that deal?
Yes, of course, what we can offer is our usual, which we really, 50% of our export is semiconductors and electronics, which we export a lot to the U.S. And then also our coconuts, which oftentimes we would lose out to our neighboring countries like Thailand. But now that the tariffs our tariffs are lower than theirs, then we will probably have a stronger edge to be able to strengthen or to add more exports to Thailand, to the U.S., the coconut, and also we have our dried mangoes, which we were actually losing out to Cambodia, but now with the tariffs, Cambodia's 49% tariff and ours is 17% tariff. This will be an edge for us to strengthen also our exports to the United States.
Will you be pushing for an FTA with the U.S.?
Yes, actually, we are going to be pushing for an FTA for the U.S. and I've already set out hoping to get a meeting with my counterpart. I'm just waiting for the schedule so we can really talk on how we can strengthen the trade between our two countries.
Philippine Trade and Industry Secretary Cristina Roque there with us. Yes. Let's take a very quick look at how we're travelling when it comes to the Asian session, and a pretty steep sell-off that continues, and not a great deal of resentment there given really a pretty terrible lead that we had from US markets overnight. Clearly investors still trying to work out what the depth of the impact is, and at the same time you've got a number of investment houses really ramping up their expectations or risk of a US and potentially even a global recession there. We're seeing that steep decline of almost 2% for the broader MSCI Asia Pacific. The Kospi there at about 1.5% lower. We did get a brief sort of blip of a sign of a potential recovery rally, and certainly a recovery rally when it comes to the won, with some of the geopolitical uncertainty or political uncertainty, I should say, being pushed to the side with the South Korean court choosing to uphold that impeachment ruling on President Yoon that now triggers an election within 60 days. Hoping, a lot of people will be hoping that brings a bit more clarity to South Korea and its policy environment. The Nikkei 225 as well as the topic seeing steep declines for a second day there as we continue to see sort of the impact on Japan, particularly with these concerns over auto tariffs from the US. Take a look at what we'll be talking about next week. As Insight heads to India, we'll be speaking with Kotak Alternate Asset Managers Investment and Strategy CEO from Mumbai on Monday, plus conversations with Geostar's Vice Chairman Uday Shankar and Citi's Head of Wealth Andy Sieg. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.